I've been asked to do a dual kind of a session. One is on angel investing, and the other is on how do you raise money, what do angels look for, or I would say how do investors look for, what do they look for when they start looking at investable opportunities. So I have a bad habit. There is a slide deck which is very brief, and I always go off the slides. So bear with me, but the idea of putting this up is to help you guys at least give you a sense why we do what we do. So, IN sort of, there's a whole journey to it and a reasoning that very many years ago we started Thai, and that was when we learned that in the valley the Thai organization really flourished and helped a lot of Indian origin, I would say South Asian origin entrepreneurs to raise money, get mentoring, figure out how to start up, how to do business. And we brought in the concept, Mr. Saurabh Srivastava, who's Chairman Emeritus of Thai Delhi, NCR, he's co-founder here, brought Thai to India, and then we set it up in Delhi, and this is what you are part of in Thai. And I sort of engaged in setting up the organization, and the reason I'm saying this is one of the big learnings that happened is at that time there was another organization which still exists, which is the Indian Venture Capital Association, which brings all the VCs, private equity players. The learning that we got sometime in 2005-06 is that there was a huge gap in what entrepreneurs wanted and needed and what was available. So entrepreneurs, especially after the first generation entrepreneurs like Narayan Murthy, Mr. Srivastava, all these guys sort of succeeded. There was this whole wave of thinking to say, if they can do it, why can't I do it? And that time it wasn't common. It was usually business houses who set up businesses. So, and on the other hand, VCs were not investing less than 7 million, right? So when an entrepreneur needed $500,000, where does he go to? And as you all know perhaps, is that banks were not an option. They still aren't, for that matter. So that's when we started to think that, let's bring in money, first of all, which is $500,000, million, something like that, so that once entrepreneurs have sort of raised their family, friends and fools money, begged, borrowed, stolen, they actually can raise the next round to build their foundations of their company to start building a serious business. And secondly, we thought that if that be the case, it is a very high risk stage for investors, but more importantly, it will be of much better value to entrepreneurs if there is an engagement of first generation entrepreneurs to help, who are coming in as investors, to help them grow their business. How do you do things? How do you set up processes? How do you do governance? How do you recruit? How do you think of your GTM strategy, sales strategy, etc., etc. So the whole point of mission of IN was and is that we would bring in the money as equity investors, and for entrepreneurs, I'll explain a little bit on equity a little later, is we bring in that money, but we also bring in mind space, time, mentoring, and leverage our global networks to help companies. And we've sort of stuck to that. Over the last 18 years of our journey, we've largely stuck to that. So that's who we are, how we started. Today, just to do what I would say commercials in between, is IN has been a very, very consistent player, and I'll give you some numbers. Our angel group has invested about 615 crores. We've given over an 18-year period, we've done an IRR of 25%, which is huge because remember it gets adjusted for time. We have MOIC of 3.7x, and this is unfair, I would say, because each angel investor decides in which company he or she wants to invest. So unlike a fund, it's not the entire capital. So if you've invested in, let's say, 10 companies and you've invested in 17 companies, right, your IRRs and your returns are not going to be the same. But we've just utilized the KISS formula of keep it simple, stupid, to say if somebody had invested in all the deals, what would they have happened? So to take off from there, we have companies which, we have investors who've got returns like 400x, 50x, 92x. That's the kind of numbers we are sort of seeing. And if I look at globally also, it's very important to also keep an eye on the failure rate, because unless you take risks, you're not going to be able to succeed. But how far you take risk is what is very important, right? And if we look at our risk rate of about, on the network, it's under 30% capital over 18 years is what has been written. So I sit as a co-chair of Global Business Angel Network. I get a lot of data, and clearly we are the lowest. So I think one is the returns, and this is for investors to understand, that one is the returns that you get on your portfolio, and the other is what do you write off. You will write off. You will write off. I mean, if you're not ready to take that write-off, don't get into the investing business, but you will write off. How little you write off becomes important. So that's how we measured IEN, and that's a big learning that we got. We have a fund, we have Fund 1, which is, just to complete the story, in 2017, we launched our first fund. We invested about 374 crores. We have an IRR of about 35%. We have an MOIC of 30.
What is MOIC?
Multiple on invested capital. So the portfolio is sitting at about 3x. We have companies which have given us a valuation. We have a company where we invested at 45 crores pre-money. Pre-money is the value of the company before the investment comes. So you're only valuing the company, you're not valuing the money that has gone in. So you always
do invest in the pre-revenue stage also?
Yes, at the angel level we do. Even, and I'll come to that. So we invested at 45 crores pre-money valuation sometime in 2019, and we are today at about 2140. So that's the kind of returns. We have a company which we invested at about 23 crores. It's discussing a term sheet at about 2000 crores. So I think whatever formula, whatever we're trying to do, putting money, and we invest a huge lot of time, mentoring, bring market access. We've got involved in changing policies to the benefit of our companies. I think all of that is showing up somewhere in the value creation. So even at the fund level, we're looking at failure rates of 19%, which is 6 years is not a bad failure rate. We've been able to do that. And 12 or 13 of our companies have each raised 100 crores. So an investment of 374 is looking more like 1500 crores straight away.
How many companies are there in the fund?
Sorry?
How many total companies are there?
In the fund?
Yeah.
So that is a unique strategy. So the larger check sizes is about 29 companies, and we do a co-invest with the angels for our deal flow. So that's a different number. So that's where most of our thing is. But we can take that question offline because this session is more on the angel piece. No problems. So that gives you a sense. Now, why do we? What is angel investment? So angel investment, first of all, is investment that you're doing in startups, very early stage companies. You can call them startups, you can call them MSMEs, you can call them what you like, okay? But it's in very early stages. It can be pre-revenue, it can be very early revenue, and it can also be in companies that are only building IP portfolios, right? Which means that the revenue may come when they're probably $1 billion valuation. You know, drug developing companies, or some IP getting created. So you invest at a very, very early stage. This is money that is which is actually coming as the first external money. And it has a lot of value for entrepreneurs. It's not only giving them the initial runway, 5 laptop खरीदने हैं, 3 लोग को hire करना है, 10 flights लेनी है, कहाँ से पैसे आएंगे? It's that money that is helping. But it is also very important because as the company starts looking for VC money, or it starts looking for institutional money, then having raised angel money is a huge endorsement. And if you get money from angels who are well known, who've either been very good entrepreneurs, succeeded, they've done garage to IPOs, or people who've invested, then of course the value is far, far higher. So I think that's the value of this money, is far beyond the 2 crores, 3 crores that they raise. And I think for entrepreneurs understand this, but I think what I sometimes have to reiterate, that investors need to also understand this value, because that value means that you have to deliver to that value as an investor, and you have to be able to figure out how you create value from that non-monetary investment that you're doing. So I think that's the piece that I think is important. Secondly, this is money which is buying shares in the company. Okay, you are buying equity in the company, so you're a co-owner. Number two, you are expected to have a significant minority in the company. Having a majority in the company or having a 49% doesn't work, and I'll give you the reasons why in a bit. It doesn't work. So somebody telling me that I've succeeded in raising money and I've succeeded in investing in a company and I've got 70% of the company, I think that's the end of it. So an angel investor is truly participating in the journey of an entrepreneur's venture. It is not your venture. You are just a partner. So you have to see yourself as that, and you have to see yourself as a partner who's not responsible for the operations of the company. Right? Because if you become an operator of the company, then you are betting on yourself. The question is that what you want to do? Right? The type of, while you are sort of invested in shares, the model that we've seen and what we use and what I've seen in India and overseas is the model of return is not dividends. So if you've invested, let's say, 50 lakhs, and you say, okay, from the third year the company is making profits and there's going to be dividend declared, that's not the model. The real returns and the kick-ass returns that you get are really when you play the capital gains game. So you invest, let's say, if the face value of the shares is 10, you invest, let's say, at 100. I'm just taking numbers to make to explain this easily. And let's say 3 or 4 years later, you have an exit opportunity either by some investor coming in or acquisition, and you get a price of, let's say, 10,000. Then you've done it, right? Then your returns are 10,000 minus 100, 9,900 per share. So you have to play the capital gains, right? And if you have to play the capital gains, you want to ensure that all the surplus cash that the company is building through its operations is plowed back into the company. That's important. Pulling it out doesn't help, right? Because your IRRs will drop, your returns will drop, the company's, basically it's going to work towards a dividend gain, which for an entrepreneur is okay, but then he or she should not be raising money from a VC or an angel investor. I'm not at all, if any of you are doing a venture where you think dividend is a good idea, I'm saying it's fine. That's a different model. But from the investing perspective, that's not the model. That's what I'm trying to say. I think that is what you're playing for. Okay. Now, if you are playing for those kind of returns, it's basically sitting at the highest level of risk in your portfolio. So you'll have FDs, you'll have real estate, you'll have mutual funds, you'll have public shares, you have art fund, whatever, I don't know. The world is full of different assets. This asset class is sitting right on top. Okay, it is giving you the maximum return.
Yes.
And it has to therefore be at the maximum highest risk. I mean, high risk, high reward is the only way we've all learned, right? So if it is at a very high risk, then you have to start thinking how you play that game, right? So the name of the game for the investors is not really that I have been able to invest and get shares in XYZ company, but your success lies in I invested and I got this kind of return. So exit is your end game, not investing. And that's a big change, because the timing of investing and the timing of exit becomes very important. And as life has taught us, in buying shares is easier than selling shares. Right. So I think that's the thinking that is constant in any investor's mind. Now, in between is where the game lies, right? So what are you looking to invest in becomes important. You're looking for something innovative. I mean, investing in another Flipkart or investing in another, take any venture is not really going to work, because the big daddy will come and gobble up the small guy. So you're looking for innovation. Innovation can be innovation of product, it can be an innovation of sales strategy, marketing strategy, it can be a patented. I mean, there are tons of innovation, tons of ways of evaluating innovation. And as you go down the path of diligence, you'll figure that out, right? But that innovation should give you a moat, so that competition is sort of not able to come in very easily, right? And yet that moat should be such that it is able to get to the customer and the customer buys. If it's too complicated a product or a solution, then it's not going to happen, right? So it has to be something that is a balance there. The second piece, which is very important, is for investors like us, we are looking, when you're saying that I'm going to play the capital gains game, you're obviously looking at the price of share going up, right? You're looking at how does that 100 become 10,000, correct? Now, if that 100 has to become 10,000, then one big factor is that it has to be targeting a very large market, right? Only then will the revenues go up like this. Okay, if it's a small niche market, then the revenues will go up, but it will go up like this, right? So what then becomes important is the product or the proposition of the company, is it a nice to have or a need to have, right? So if it's a nice to have, let me explain this. If I go to a boutique and buy a nice lehenga, for example, it's a nice to have. At the end of the day, if I don't have it, I will still be able to do what I need to do, right? I'll probably wear an old sari and go to a wedding. It's not going to curtail my life in any way. But if I go and buy a shirt, it's a need to have, because I can't do my daily work without a shirt. So the need to have and nice to have becomes very important, because then it becomes a compelling product that your customer will buy. And if your product is good, it will scale fast, it will have a number of customers. And these are points I think even entrepreneurs, you guys can also sort of take note, because it's the other, if I just have to reword it differently, that's about it. So
yeah, maybe when we're talking to Abhishek, then we can just use these, like how are we filling the blank?
yeah, but I'm saying it's sort of a different perspective of the same point. So I think need to have and nice to have becomes very, very important. Right? And then you go through all the diligence that typically investing needs, which is competitive analysis, your product, how acceptability. For entrepreneurs, it's important to be able to show some sort of endorsement, whether it's a pilot project, whether there's a big guy who's saying, yes, if you get into the market, we'll buy this, here's an LOI or something. I think these are very early endorsements that do help for companies. And I think investors should be looking for this, to my mind. So that piece becomes very important, okay? The second piece that becomes very important is how you may have a very large market, you know there's a large customer base, but what is a company's way of getting to that customer base, and how are they going to convert those potential customers into real customers? Because without that, kuch nahi hone wala hai, right? So that, to my mind, becomes extremely critical, because we've seen a lot of companies with excellent products but with a very weak sales strategy and a almost negligible sales conversion strategy, and that is the end of it. No, let me finish, please. Just write down your points, it'll be easier. So from that becomes the piece where the product actually starts getting monetized. It's the path to monetization. So having a great product, having a great technology, having a great user logic is no way enough. To me, that's 20% of the journey. If you don't have it, yes, it won't work, I agree, but it's 20%. 80% is how are you going to make money, and if you have a very, very high-end product and the customer is not willing to give you high-end pricing, then it's still a waste, right? So you have to say, okay, this is a very high-end product, nobody's buying it at this, how can I reduce the BOM cost? BOM is bill of materials cost, right? And make it such that I ultimately make profits for a lower version product. I would even go to that extent. So I think this pricing, customer conversion and getting revenues is I can go on and there's a lot more beneath it, but as a headline piece is very important. Second is, all of this is nice, you'll get an LOI, you'll get an order, you'll get a purchase order also, but how is the company going to be able to deliver all that, right? If it's a hardware product, is it going to get manufactured, is it going to be built, is it going to be remember it's a startup, it doesn't have money, it doesn't have a manufacturing base, so how is it going to do? Is it going to subcontract, is it going to outsource, how is it protected? These are the things that investors have to be very careful about, right? Because that's where the slippage can happen. And how does it then get packed? How does it get delivered? What are the logistics? Logistic costs can go, they are out of the roof. So there is a lot between getting a purchase order and sending out an invoice, right? And that piece is where, again, in our view, we've seen a bit of a lumpy scenario. And once you've sort of been able to get that as the big piece, everything done, you've also invested the money of delivering, how is it that you are able to collect money? So, what I'm trying to tell the investors here is, I think a lot of this for entrepreneurs is easier, but for the investors is that you're actually looking at it bottoms up rather than top down from a strategy. That's the big change that is happening, because it's a ground level startup. So a lot of it is, how do you look at it bottoms up? That's the whole point. The piece that I think I spend a lot of time, and for me, which is very, very important, is the founders. I'll be honest, I have declined deals where I think the proposition is very good, there's a real problem that the customer is having, where there's a large market, where they have a way of delivery. I have still declined it. Okay? Because for me, the most critical factor is the founders. Do they understand the customer problem? Do they understand the sector? Do they understand what is being developed by them? Do they understand how they are going to be able to embed it into the customer's value chain? Remember, there's integration, there's retrofitting. All these nice words are very important, otherwise it's not going to work. And most important is, are these guys going to do this business irrespective of my money? Okay? Are they leaders? Are they going to be, it is very important to say, are they doing it because they want to say, I'm doing a startup? Are they doing it because they're going to raise a couple of term sheets and say, hey, I raised round Series A, Series B, Series C? And I'm being very honest, I've seen all of this happen. Or are they going to do this because they really actually want to build a business with their head down? And do they know what are the challenges and how are they going to manage those challenges? Right? Do they know what they know, and do they know what they don't know? And how are they going to then plug their don't knows? Whether it's people, whether it's technology, whether it's whatever, right? So I think, to me, 70% of the weightage is people. I have invested myself in companies which a lot of people have said it's not going to work. It's because of the founders that it has worked. We've looked at companies which are in very competing spaces. Wow Momos is a classic example. How easy is it to copy that, right? Yet we've invested twice over. We were the first institutional investor. We've also invested from the fund. The single factor, overarching factor, was the founder. He's so kick-ass that it's actually saying, if I don't invest, I'll be making a mistake. So the founders are very, very important. And they have to understand also that they're not only 24/7, they are 24/7 into 365 days. And they have to be salespeople. The CEO of the company has to be a salesperson in every way. Even procurement is a sales activity. Recruitment is a sales activity. Delivering is a sales activity. Everything is a sales activity. even to that extent that managing your home is a sales activity. Unless that attitude is not there, it doesn't work, to be honest. So I think from an investor's perspective, that becomes absolutely critical, right? And something we at IN believe is we are a little more quote unquote, please guys, feel free to eat. I mean, don't let it get cold. The piece that we at IN feel, we do spend time in diligencing. We do spend time in assessing. We do spend time in looking at compliances, okay? And I think investors should, because if we want a well-governed ecosystem, we want well-governed companies to come out of this country, then I think there's a lot of onus on early stage investors. And I think that's very important. So to my mind, we are trying to walk that path, and we'd be very happy if more people, irrespective of whether you join IN or not, that you do this, because then we get much better quality of companies and it improves the overall ecosystem. So we spend a lot of time, to be honest, and we are not too unhappy about that. Our percentage of issues in our companies because of governance, because of non-compliance, because of cash flow issues are I think the lowest, to be honest. We probably had one or two in a portfolio of 225, 230 companies, whatever that number is today. I think that's very important. And I think our investors, whether they're fund investors or they're angel investors, resonate with that. So again, as you get into the angel investing activity, it is a lot of focus there. And finally, I think comes the hard question, which everybody asks me, so I'm going to try and hit it head on, is how do you value a company? How much should I take? How much should I not? And then entrepreneurs ask me the same question, so how much should I give away? How much money should I take? I think valuation is more of an art than a science. The reality is that investors are performing as soon as you decide the number, and on a basis that entrepreneurs are promising what they're going to do in 3 to 5 years. So I think that's the big piece that investors need to understand, that if you are going to perform on the basis of a promise, the promise may not come through, right? So either there may be underperforming companies, and I dare say you could also have overperforming companies, but you could also lose your money, right? So I think that risk appetite for investors is something each one of us has to assess. And while I'm on that topic, I've taken a slightly tangent, is angel investing is not for the weak-hearted, for sure, okay? If you have wealth enough, and enough of wealth which is going to be disposable wealth, not income, please notice, then get into the space. You should not be investing and then losing nights, sleep at night. I have had many investors call me, "Mera company ka kya hua?" And I said, then don't invest in the next company, because this startups do take time. They take 6 months, 10 months, they could be at the same stage. So remember, you are taking a risk. You have to have the appetite, and you have to be able to sleep with that risk. And yet your lifestyle, your commitments to your family, whatever should remain undisturbed. So that's why I think this asset class does focus on HNIs, ultra HNIs, kind of. That's the reason it goes there. On valuation, I think what we've largely seen rounds of, let's say 2.73, between average of 3 crores, early stage companies. It is determined by sectors. Certain sectors will be higher valuation, certain lower, but I think we've seen somewhere between 15 and 25, kind of. We've taken some companies, we've taken 30 also. Some we've also taken 3%, right? But it's the stage of the company which is sort of what we see as angel investable company. There are different investors have taken different calls. Vinod Khosla has a very simple thing. I like this company, I like this entrepreneur. For me to put in time, let's say I need to have 30% of the company. And he throws it back to say, okay, you want $1 million, I'm willing to give you $1.5 million, but I'm not going to move from 30%. So your valuation automatically gets adjusted. Others come up with a number that this is what I want to do. Unless I have X percentage, okay, I'm not getting into this space, because holding 0.5%, 1% doesn't help. That's the other way of looking at it. Some have done kind of tried to do scientific formulas like DCF model and project market analysis and all of that. But what I've seen, those are great indicators. It could suggest that the company is, let's say, 20 crores worth. But after that, वो negotiation पर आई जाती है. So I think entrepreneurs and investors both have to be very clear that there will be negotiation, and it truly is not a question of who wins, who loses. Okay, it's a question of how you perceive each other. So if the entrepreneur feels that he's going to get more value beyond the money, he does lower. Okay, and if the investor feels that I'm going to not have to put in too much time in this particular company because the founders are good, they have a good support system, they have a team, then he could walk away he could still do it at a higher valuation. So I think it's a case to case and a value that you see in each other as an investor, and what value you may, if you think that no, I'm going to spend a lot of time as an investor because they don't have let's say a CTO, for example, right? And I'm a techie, I can help them, then the valuation sort of obviously changes. So there is this whole piece that moves around in that sense. But average, I think 15 to 25 is doable. In angel investing in India, I've not seen checks larger than 6-7 crores. We've done, I won't say we have not done, but those have been very rare exceptions. So kind of 6-7 crores is the round size. I think the other piece for investors, before I just come to, this is my last point for investors. I think because it's a a risky asset class, I think risk mitigation becomes very important. So you have to adopt every single way of risk adoption, risk mitigation. So you have to be able to see investment opportunities across sectors, across geographies, across stage of companies, across business models, all of those, right? And in our minds as IEN, and considering what we brought in the concept into India, I think the piece that convinced a lot of our people to do this was to do this jointly, right? So we have a group, and that group basically invest together, but doesn't mean that 500 investors invest in one company. A very small minority does. You may have 20-30 investors in each company, but those 20-30 investors are coming in with different backgrounds and different domains, right? So for instance, if you are in agriculture, then an agri-deal in an agriculture startup, you may be taking the lead, you understand the space, you can add value, you can mentor the guys, you can do ABCD. But somebody else from the investor group says, if he is putting money as an agri specialist in an agri deal, तो मुझे पैसे लगाना चाहिए, right? And similarly, if you are in textiles, the reverse holds true. So angel investing to me is a combination of promoter and peer investing, right? So you are investing behind the promoters, the founders, how kick-ass they are, how they perceive them as being able to execute, build a company, take it to scale, as well as who's helping them. Domain expertise, geography makes a big difference. We've invested in companies in the US, we've looked for a active investor based in the US, for example. Because how are you going to monitor that two-man company then? Right? It's a reality. We invested in a Canadian company. Everybody thought it was a write-off, right? We got a great return purely because we had somebody in the US who figured out that he was an LP in a fund who had invested in a company, and they were looking for this technology, and he could bring the two together, and it was a huge success, right? We had flown in money from 14 jurisdictions, we brought back money to 14 jurisdictions believe me, all of this was done sitting in Delhi, right? So that piece is very important, to be part of a network, because that network can bring a lot more than just saying, I'm sharing. I think sharing 2 plus 2 makes it 22, not 4. So I think that piece helps you to risk mitigate. And I think the last is, which we felt was very important when we started. Angel groups around the world were very over dinner, clubby structures. 3 entrepreneurs came, presented, somebody said, puts up their hand with a drink, and then it's the entrepreneur sort of connected to that one investor, and nobody knows what's happening. So I probably, when I started, I didn't want to run a club, probably came from there. But what we saw as an opportunity is we can build a very strong management process and operations where we did from sourcing to exit. So from sourcing, building a brand, to sourcing the deal, to shortlisting, to diligence, to negotiating, to doing the term sheet, to doing the documentation, to monitor the company, add value. You know, you may have not invested in the company, but I know you can help as an investor. I'll call you and say, hey, I need help. And I have not yet received a no from anybody, to be honest. Because, you know, the reverse it can work for you also. In a company that you've invested, someone else can help. So we built that, and we decided that from brand to the last man holding the last share, we will run the process. And that gave us huge depth, huge understanding, and to be honest, a lot of experience. You know, I would have done at least 400-500 transactions. We've done exits, we've done secondaries, we've done bridge, we've done grants, we've got debt. All of this sort of helps the investors to create value. Of course, it helps the entrepreneurs, but I think in a company we had invested 2.5 crores, I got them a 3 crores of grant. Half of their value, right? So valuation, I mean. So I think that is a piece that makes this ecosystem, angel investing, work. So I'll stop there for angels. I'll just focus on the other side of the table, as that's what was requested. So I'm trying to go and make it very swift so that I leave time for questions. Sakshi, can you ask for a glass of water? So I would say there are 5 or 6 points very quickly. Okay. Point number 1 is proposition. What is your proposition? Is it innovative? Is it got something which will make it stand out, which is not easily copyable? Okay. Is it solving a real problem of a customer? Right? If it is not solving a problem, as I gave you an example, I mean, a shirt is solving a problem, a lehenga is not. Right? Is it solving a real problem of the customer? That's very important. I don't know, y'all are all young here, but people in my age group will remember a pager, which was a one-way communication, right? It didn't solve the problem of communicating. It just relayed a message. But the mobile did. But the pager solved one more problem, that while we were on the go, we did at least get a message, which the landline could not, the rotary phones. So is it solving a problem? That's the big thing. Okay? Is it doing for the customer something that is different, or is it doing something differently? What is differently? The entire BPO industry has been created on doing things differently. That's the innovation they did. They pulled out all the staff functions like accounting, HR, payroll, said we'll do it. That's the crux of the BPO industry. After that, they've created layers of it. So is it doing different or differently? That's the piece that you need to really think of as an entrepreneur. Second, again what I said earlier, is it something that there's a large customer base who will buy this, right? Because of the model of investing and returns that these investors have, you will need to build the top line on a hockey stick curve. Very important. And that can only happen if you have a large market. Remember, even if you have $1 billion size market, you're not going to be able to access 500 million. I mean, 50% nahi hone wala. You're going to get single digit at best. So it has to be a very large pot size. Third, you have to think through how are you going to get through that market? What is the competition in that market? What's going to be your differentiator? How are you going to, you need to understand competition very, very well. Okay, so research, competitive analysis, understanding what are the different evolutions that you will bring. Because today you will have one product. Tomorrow, once you have money, you have resources, you've got customers, you've got experience, you build the next. So that path to building the product or technology becomes very important, right? So that's the third piece that is important. Fourth, again, the sales strategy. How are you going? Who is the customer? Who is the customer is the big question. So if you have a software product that you're building, let's say for HR, who is the customer in the corporate? Is it the CEO? Is it the HR head? Is it the IT head or is it the finance head? Right? To make it simpler, if you are selling toys, who's the customer? Is it the parent or the child? So identifying the customer and building your customer acquisition strategy around that becomes critical. Otherwise, you'll be wasting your time and nahi hone wala hai. And once you deliver it, how are you going to build it, develop it, and deliver it? But also, delivering doesn't mean you have a box delivered at the customer's site. How is it functional? How is it using it? How is he using it? So is it integrated into his IT? Is it integrated on, like we have a company called Chakra. They have a retrofittable device which is fitted onto generators to reduce pollution. It reduces pollution by 98% in less than 60 seconds. Now, if they decided that I have this device, I'm going to pack it up and deliver it, nothing's going to happen. It's going to stay there. It's going to stay nice and packed. The only way they can do it is they fit it on the generator and get it functional, and then they have an AMC to make sure there is a servicing that happens. So you have to think through the whole thing because you're not delivering a product. Remember, you're delivering a solution. That's the difference. So that is where I think a lot of conversations I have with early stage entrepreneurs stops. हम भेज देंगे ना उनको. अरे पर भेज के वो करेगा क्या? Right? How are you going to build a team? I mean, unfortunately, God has not made anybody in this world who knows everything. That's the reality. So what is it that I need to build under me or besides me? Do I need another co-founder? If we are two co-founders, do I need a third co-founder? Right? How are we going to knit the team? Right? How are we still clear that within the three co-founders, this is his job, this is my job, and this is her job? Right? Who's responsible? The investor will know whose collar am I going to hold when there is a problem. Who is the CEO of the company? The investor is not going to say, okay, this is a CTO related job, so I'll go to the CTO. वो नहीं होता. The investor is only interested. Customer is unhappy. Revenues have not come. There are complaints. Whose neck am I going to catch? Okay, so this is not going to be probably in any deck. So I'm giving you things that I've seen in my life more than anything else. If you don't clarify that amongst yourselves, it's not going to work. It is not the investor's job to solve this. It's your job. And it is not for the investor that you are doing this. It is for you and your business that you are doing this. That's the important part. The investor is not your boss. He is a quiet guy sitting at the back row as somebody just walked in. Hi, Raman.
Hi.
So whatever you do, remember, it's for your business. He is just coming in to say, ये सब अच्छा दिख रहा है, इसमें potential है, चलो थोड़ा पैसा लगा दो. That's it. He is only bringing a little bit of money. If he's a nice person, he'll bring a little bit of mentoring. If he's a nicer person, he'll write a few mails to connect you. But if he doesn't do all that, you can't hold him to it. So it's you who has to work independently on your own to build all this. So that is where I think we've seen a lot of, I wouldn't say a lot, some friction that happens between entrepreneurs and investors. And I think just as entrepreneurs need to own the business, I think for investors, I've seen a lot of investors forgetting. And it's good because, it reflects that they've been entrepreneurs themselves, or they've built businesses, or they've been building large operations. There is something called moving from captain to coach. So when it's your business, then you are the captain. But if it's not my business, then I'm actually outside of the playground. I'm in the trenches, right? Just clapping when you're doing well, and when you need help, just giving quiet advice and showing you the mirror. Ki bhaiya, you are at a crossroad. If you do this, this is what could happen. If you go this, this is what you could happen. The choice to take the path is the entrepreneurs, because it is not the investor's business. The investor is just participating in someone else's journey. So I think those are things which need to be very clear, and having very candid conversations between the investor and the entrepreneur. Once you've reached a certain level of comfort, you've reached a certain level of discussion, I think it helps a lot. I mean, we have companies, I sit on some boards, we have very candid conversations. I mean, if I have an issue, I have entrepreneurs who take my call on Sunday evenings, and I have told people also that don't call me on Sunday evenings. You see, you have to build that piece according to each relationship that you have. It's purely like life, right? It's nothing different. So those are some things. In terms of valuation, I already touched upon it earlier, so I'll not think. I think the one piece that is very important from our perspective, and I think it has stood us well in our 18-19 years of existence, to be very conservative players. What I mean by that is we invest in businesses other than a very small fraction, which I think are the IP portfolio builds, where there is no revenue, they're just building IP. Basically that portfolio or IP develops and somebody will acquire it and the company will get returns. Let's leave that part. But 90% or more of our companies are building revenues. And we invest in companies, and I think everybody should, and I think the ecosystem is learning this, is we invest in companies which have a hockey stick top line or a revenue line, but the entrepreneur cannot lose sight of the bottom line. Now today you may be making losses, today you may be burning money, and we understand that. But 2 years, 3 years, 4 years, whatever your numbers show up and whatever it has to make money. It has to become BEP. It has to hit that point, okay? And what really helps, and this is what I tell our companies, is you have to think cash flow. So if your CA is going to give you a P&L and a balance sheet, बहुत अच्छी बात है, that is for your compliance. But for you as a CEO, as a CFO, as a CXO, what is important is cash flow. You know, गल्ले पे बैठते थे, वही बनियागिरी आज लगानी है. कितने पैसे आए दिन के अंत में, कितने पैसे गए, मेरे पास बैलेंस किया है, सुबह में when I open my shop, what is my balance? And all my planning, all my recruitment, all my spend, everything is on that number. Second, we look at gross margins. If that number is fluctuating, business is not stable. Unit economics, extremely important. Because unless you are not looking at profitability on every unit, you're not going to ultimately make money. Because after that, you are only going to be adding costs, corporate costs, marketing costs, brand cost, whatever cost, right? And finally, I think I'll just end with this last point. What investors think when they speak to entrepreneurs, if they are two things. Are these the entrepreneurs where I want to spend time with? Is there a chemistry? Is there some sort of meeting of minds? You know, if I'm a tough person, I'm not accessible, I think I know everything, I'm not willing to be open, I would probably say, sure, go ahead, I'll stay back, right? So I think the first thing is the chemistry in one way. The second thing, and I'm giving you a cheat sheet of what investors think. So investors in the room, I'm giving away your game. There is what I think is how, what, and when. Okay? What is going through my mind is that if I'm going to invest in this company, what kind of returns am I going to make? Is it going to give me 2x? Is it going to give me 10x? Is it likely to give me 30x? That's what's going on in my mind. They will not tell you this, but all their questions will somehow gather together to feed into these three questions. Okay, how am I going to make money? Okay, is it going to be कि 2 साल में कोई VC आके मेरी shares ले जाएगा ये, या acquisition होने वाला है, या what is going to happen? How am I going to make money? And the last is, when am I going to make money? When will I get returns on my shares? And the reality is, it never works the way that I think it will as an investor. So, but those questions are still very important, because unless unless you've got the investor to start thinking on those lines, you're never going to get money from him, from an entrepreneur's perspective. So there are a lot of other issues we can talk about, ESOP, there are 100 other issues, how do you look at financials, but that's for another day, another time. I'll stop here so people have time to ask questions.
So how important is it to fill in the blanks, piece that I was asking about? Because there's a format which is required. One is that you know how to do the business, because we are all very candid over here, really speaking, what goes in.
Which format are you talking about, so that I have a good, is it something IN has given you or what?
Yes, what I heard today, what I heard from you, in your experience, what is important.
What is fill in the blanks?
Sure. So can I start from the beginning?
Yeah,
My
please.
question.
But quick, not a long question.
Yes, absolutely. So how important is it to be a storyteller versus just going, when you're meeting someone for the first time, how important is it?
Okay, let me reverse the question. You're meeting me for the first time?
I am. I
Okay.
read about you.
Okay,
I
did
saw
you think I was interesting because I was trying to tell you a story and I was not referring to the slides?
I think you were very structured in terms of what should be communicated first and then what is important. So there was definitely a structure.
And you found it interesting?
I found it to be I was able to engage myself throughout all of this time.
That's exactly what you need to do with a first-time investor, when you speak to an investor first time.
Right.
Answer?
And lots of practice.
Yeah. Please, I mean, this is what I've learned: is any pitch you do for investors, please practice it in front of the mirror. Your words, your expressions, your body language, how you hand over as you're pitching certain parts you may like to present, you may you may want your co-founder to present, how are you going to hand the baton over. It should be smooth, because that smoothness is going to tell the investor how well knitted you are. So 100 times practice. Raman, you want to share something?
No, it's not just the mirror. Mirror is important, but practicing and pitching to people who will tell you what you're doing wrong is extremely important. A lot of us, when we present, people come back and say, oh, but acha, you had all the things. It is because we practiced. It is because people critiqued it and told us. I mean, should I tell you a little secret? There's a small fee for that.
Yep.
Even the jokes, at what point they are done and what. Those of you who attended, I like making people laugh. Jokes are practiced to see that you do it right. There are pitches that I have done, which I have practiced more than a dozen times, all in the space of 4 days, because it had to be got ready. I'm just trying to bring out practice point that she's making is very, very important. So,
yeah, I'll just add to this. I'll just tell you, I'm raising a fund today, right? So I'm presenting to investors. Unfortunately, unlike Kaustubh and Abhishek, who are much nicer people than me, they give you a slot, they give you a calendar, they stop everything else, right? They either meet you, they've given you that 30 minutes, 45 minutes, 1 hour, I don't know, whatever time they give, right? I don't get that opportunity. I'm having drink with somebody in a godforsaken airport with a bag in one hand. That guy is looking for his client, and within 3 minutes I have to make a pitch to say, you must give me time because this is what I'm doing. And you have to get it down to that 3 minutes. So I will have at least a dozen types of pitches that I have for my fund. Even Raman, probably you don't know this, but I have dozen type, and every time on my phone I'm going through these pitches that पता नहीं ऐसी जगह में मुझे कौन मिलेगा, right? So
Thank you for being so vulnerable. It really helps.
yeah, so that should help you in.
Hi, my name is Rachit Jain.
Hi,
Lovely
Rachit.
meeting you.
Lovely
I
meeting
have
you
two
too.
questions, one on the investing side and then I'll get to the real side.
Are you an investor or are you an entrepreneur?
Both.
Okay, great.
Let's call it
That's
that.
even
I'm
better.
too young
So
to
you
do
are
all
investing
three.
in your own company?
I'm investing my father's money in my own company.
Okay, can I meet your dad?
Yes.
I want to
we'd love
pitch the
meet
fund,
you.
yeah.
We'd love to meet you.
Okay.
We'd love to meet you. Just actually on that side.
So Sakshi, take his numbers.
Yeah. I met Abhishek actually, we met at Thai.
उसकी फायदा नहीं मुझको
अच्छा,
चाहिए.
ठीक.
I want to meet your dad.
No
You're
worries.
too young.
I'll schedule that 3-minute pitch. But anyway, I was saying on the investment side of it, what usually size of a kitty do you expect the investor to actually bring in, like a bigger amount, not per deal? But what should be the ideal? Because again.
So it's a good question actually. So typically let me put it. People have asked me this question many times, and I've sort of done some data analytics because we've seen investors invest with us over the last 18 years, and I've spoken to some people. This is what the overall feel is, and again, there's no science to it, but no less than single-digit percentage of the overall wealth is what should be allocated in a risk asset class. Okay, is what I've seen.
1 to 5% ideally.
Could be 9 for all I care. Okay, but again, it needs to be spread across different assets. So it could be startups, angel investing, it could be VC funds, it could be other unlisted space that you may do. Right? Private equity today, you get pre-IPO, you get growth stage. So across that is what I've seen people.
Thank you so much for that. Now just coming.
Provided there is, you have sort of shored up all the basics and your aspirational needs of life and family.
Yeah, so again, just a separate fund.
Yeah.
And just coming on the question for me, from my dad. When you go in for a pre-revenue round funding, right? We're at a stage where our product is ready, but we haven't gone live yet, right? So service, it's a B2C product, and we have no revenues, we have no users. We're just literally awaiting launch next week. At this point, when you're actually going to talk to investors, how do you plan, like you said, valuation and fundraising? Am I supposed to ask money for the next 3 months, 6 months, 1 year? And like you said, all these projections and all these checks, I mean, they
Okay, let me call one of my colleagues here,
Please.
and I'll add on. Kastab, this is a question you have regularly. Pre-revenue company likely to launch, needs to raise money. How much money should he raise for a runway of 3 months, 6 months, or what? That's the question?
Yeah, or
Okay.
1 year. Like, or
Essentially,
whatever.
you would want to look at is how many or how often do you want to go back to the market? Because fundraising is not a simple process. It's not that you talk to someone and you get the money in. There's a lot of documentation, there's a lot of process associated with it. So every time you go to the market to take money is time taken off from you executing your product. So you have to be very calculative about your own time. Of course, someone can engage with you for a month, 2 months, given what we saw last year. We saw deals which were extended all the way to 9 months of diligence. And that 9 months is taken off your execution. So are you taking in, so when you have to be clear, how often do you want to go back to the market? Second, how much do you want to par away? Are you willing to go at a very early stage where the risk is exceptionally high, where the investor wants to have that comfort that they will take a much larger portion of your equity as opposed to after having some amount of fraction? Basically, what a fraction is going to do is de-risk the fact that this will work or not. Someone has given you some money to validate that. So that's point number 2. And point number 3 is your own calculations with how well can you depend. So these would be the 3 broad points
I would just add one more point. Please plan for your plan not to go according to plan. That's very important.
This is the business plan.
Sorry?
The business plan.
No, so if you are planning that you need 1 crore, assume कि तुम्हें ज़्यादा लगेगा. Because you will make mistakes. Okay.
Usually when it goes for 9 months, that's a late stage deal where there's a lot more data that needs to be got.
Yeah, go ahead.
Have a much deeper team.
Padmaja, we are-
A lot more
Cost.
data.
Let him finish. Cost.
But roughly, think about it like 20 hours a week, you have to constantly convince the investors. And not just the investors, their legal and financial team, the third party which is doing your financial due diligence, your legal due diligence.
So Padmaja, we are the sports and fitness space.
All the
We have a-
So it is a very Herculean task.
Okay, Costa, we have a second question. Yeah.
Padmaja, we are in the sports and fitness space. My name is Sumit.
Hi.
So we have served some 27,000 customers already.
Excellent.
And we're just looking out to raise funds. So what do you think about, going to our stakeholders largest, which are our customers, and raising funds from them, utilizing our loyalty, our goodwill? What do you think about that?
So I will, before I answer that question, I want to make a point which actually de-sells what I do in life. Okay, if you can build a venture, a business rather, on revenues, customer revenues, that's the best way to build a business. Okay, best way. After that is grants. Because there are no free lunches in life. If you take a grant, there'll be some non-financial way that you will be doing something or the other. Then debt. Okay, because when you take debt, you don't have a corner. You're not sitting on the board. There's nobody sitting on your board of your company. You're not eating your head, right? And you have capped the financial returns that you have to pay back. If you're, let's say you're taking debt at 15%. I'm just taking a number out of the blue.
Right.
Then you know that I'm going to be paying 15% and I have to pay the capital back. That's it.
Principal.
Right? The last option is equity. So while I am an equity investor, I'm making this very clear because I think this is what entrepreneurs should be thinking to build their ventures. Okay? To your question, look, if a customer invests, it's a huge endorsement of your product, your business. But what you need to worry about is if you're getting a Nike, then Adidas may not come. Right? Because they'll see this as competitive.
Okay.
Or Nike will say you can't get some other sports player. Right? And if it's a strategic from your customers, then you have to understand that beyond money and beyond shares, beyond being a financial investor, what does he or she want? Why does he want to invest?
Right.
See, a financial angel investor, whether it's an angel, whether it's a VC, whether it's a bank, right? It's very clear. मैं पैसे डाल रहा हूँ मुझे equity मिलेगा या मैं पैसे डाल रहा हूँ मुझे interest मिलेगा, जो भी है. But if it's coming from a customer base, it's clearly an organization or an individual who's in that business.
In the B2C space.
Or whatever, then you have a strategic connect. And that strategic investor intent needs to be very clear and documented.
Right.
Okay?
Can I ask? So,
I'll come to you. You're not on the cards.
No, I'm not asking a question. I just want to
Add.
reinforce some of the points that Padmaja made. So she brought out equity as the last thing. Yeah, I'm just saying the same thing in different words. Equity is the single most expensive way that you can raise money. So a lawyer comes and says, give me equity, I'll give you law advice, I'll give it. While Padmaja rated it out as the last option, it can mathematically be shown that it is the single most expensive way for you to raise money or get services or buy goods.
Correct.
I'm just placing it in different words to bring out the way you should look at it.
And I will tell you one more piece. Equity money is inequitable. Because I am taking equity in your company, but I'm going to have preferred rights. I will want to approve your budget. I will want to approve, let's say, debt over a certain amount. Right? So, you need to be aware, and investors also need to be aware that you have to be able to have these rights. That's why I said, rights, how do you get into valuation and all that is a bigger diligence and all is a bigger session. We'll park it, but it is inequitable. I will be, in some ways, I will ask for things beyond you. Right? So I can walk you through all of that, but just as a quick answer.
Hi, Padmaja. Hi, this is Ashif.
Hi.
So I've been an operator for most part of my life. Built and scaled a company called Haptic, which we sold for 100 mil. So
Yes, I am
saw
aware.
some-
So congratulations,
Thank you.
and
So
good
saw
to
some
meet
light
you.
on the other side of the tunnel finally after having some failed ventures. And obviously having felt that success, I obviously want to give back, and so I started actively investing. I've invested in about 45 startups in the last 4
Excellent.
years. Fortunately, 7 exits.
How come
already.
you are not an I?
I have to have that conversation. So I've been actively investing 7 exits. One question that I saw in the beginning: how do you track a rolling, MOIC, a rolling IRR on a portfolio like this? Because my portfolio is about 3.5 years old, and constantly some companies are raising their Series B and C.
Yeah, it's a lot of hard work.
But
Let me.
just out of curiosity, like how do you do it? The companies that are on their Series B and C, do you use their current multiple and sort of keep it in track? I mean, I obviously use Angel List and they do some amount of work for me, but then I also have
No.
investments
So
externally.
we are very simple people, with people like Raman who drive us into that simplicity. We keep
Yeah.
it simple and we keep it stupid.
I'm gonna come to you.
We keep it simple and stupid. So we basically build our valuation, our IRRs, everything on the basis of the last round that the company has done. That's it. Okay, because if I add any other factor of revenues or profits or customers or anything, then it's subjective. So we've kept it very stupid and simple to say, हमने 10 करोड़ वैल्यूएशन में डाला, 2 साल के बाद उसका 50 करोड़ हो गया, हमने वो एक शेयर होल्डर्स अग्रीमेंट हम पढ़ सकते हैं, ऑडिटर पढ़ सकता है, उसके ऊपर हम करते हैं और टाइम फैक्टर लगा के मॉडल करते हैं.
Yeah, so the last round is the
Last
part. Thanks.
Last round pre-money.
Yeah.
The cash flow to calculate IRR, it is not the theoretical time you get money when the cash leaves the bank and the cash hits the bank.
Yes.
That's it, nothing else matters.
Yeah, cash basis.
Yeah, no,
Cash
it's true
basis.
because even in Angel List, there's a date when we sign the document, but the cash actually hits the account like 2 months later. So I use that. as
No,
the cash basis.
I have a comment to make on the organization you used. No, you are using, but ours is very simple because for us, I think today it is very, very important for investors. See, one of our fundamentals is transparency. This is one of those transparency pillars kicking. And you should be able to, your accountant should be able to, your auditor should be able to, your CA should be able to, whoever's filing your returns should be able to say 10 करोड़ में डाला, 100 करोड़ के वैल्यूएशन में आया, इस दिन पैसा आया, इस दिन पैसा गया, इस दिन ये documents है. So he should not need us. That's where we are going.
Excellent.
Okay.
Hi, my name is Anwar. I have a question for both of you. In your experience for many years, what are those?
You make me sound old, yeah. Don't say many years.
Many could be 2 also. So, in your experience, what are those very common mistakes that founders, entrepreneurs have made while setting up the organization? Purely around legal, regulatory, compliances point of view.
We'll give you our perspectives. Go ahead, Padmaja, then I can.
So, I think it's a tough question because it's really going down to diligence that I'm pulling out from the diligence that we've done. I think from day one we've seen gaps in compliance in how companies are formed. Okay, we invested in a company which had a 20 crore revenue. We wanted to invest, let me say, and finally we did. It was a partnership. Okay. The partnership had licenses, it had IP, it had revenues, it had costs, it had everything. Now, if I join the partnership, it doesn't help me because as an investor, I need shares. I don't want to be part of a partnership which is unlimited liability, etc. So how do I invest? And how do you raise money? So number one is set up a company with shares. 2 shareholders with a setup of one, right? So that's the one thing. We had a massive exercise of converting that partnership. Even OPC, I've worked with to convert. It's a massive issue. There are tax issues. There are licenses. Licensing authorities don't allow you to transfer all of that. Okay, you lose history with the licensing organization. That's one piece. The second piece, I think, which is very important is, and I've seen this happen, resolutions hote hain. When a company gets started out, okay, most entrepreneurs, and you've got gray hair, so you may not fit the bill, but most entrepreneurs are doing it for the first time, right? So they are going to their dad's CA, or they're going to some, the dad's CA who you know for donkey's years, who's been there before you were born, gives you a bunch of papers, and you are saying, sign kar do, resolutions, okay? It has happened, a live diligence has happened, okay? The diligence guy calls me and he says, ma'am, एक problem है. I said, क्या हुआ? He says, आप ये कंपनी में इन्वेस्ट कर रहे हो, इसको कुछ भी नहीं मालूम है, इसको कोई गवर्नेंस नहीं मालूम है कंपनी में, हुआ क्या? He says, the board is appointing him as MD. There is a resolution to that. He has signed it. How can he sign his own resolution? Right? I think it was very fortunate that I was mentored by people like Raman, and they basically, we said, is this an error of omission or is it an error of commission? So they advised me to say, go and talk to the guy. हुआ क्या? When we went, he says, Padmaja, I'll be very honest, उसने मुझे इतने papers दिए, मैंने ऐसे करके papers खटाखट sign किया, मैंने पढ़े नहीं. So the issue is, please read everything that you sign. Because if it had been some other investor, I don't know who, then the guy would have never raised money from him. So these small things are important. Third, I think, is getting all the compliances on getting the right. You get your TDS, you get your GST, you get your PAN, you get your DIN, you get your... that becomes very important, because later when you go to raise money, anything that's not done, you have to do. And you lose time. Right? And if you have got revenues without GST, then that's another complicated situation. So do that. If you don't know, get people who are high quality. Doesn't mean that you pay through your nose, but who are high quality. And therefore even talk to people at iron. Even if you don't want to raise that money, even if you don't want to raise at iron for whatever bad reason that you may have, but talk to people who've done this, so you're at least on a good path. Right? Fourth is authorized capital. Okay? People think that authorized capital, there is a fee structure to it. Right? आज मेरे पास पैसे नहीं है, मुझे तो 10,000 शेयर से ज़्यादा देना नहीं, मैं 10,000 शेयर का ऑथराइज कैपिटल. वो सीए आपसे बोलेगा, सर आप 10,000 मत करो, 12,000 कर लो, 2,000 रहने दो ऑथराइज, क्योंकि 10,000 आप इशू कर दोगे. राइट? Now you've forgotten, you've raised money, you've forgotten कि मेरा 2,000 authorized capital पड़ा हुआ है, right? You raise next round, you have to increase your authorized. So I'm not saying you should take 300,000 authorized capital, or I'm not saying you should take a very large, but think for 2 rounds, or at least say that if I'm going to do 10,000 now, I will need another 20,000 later, whatever that number is. So keep a buffer. You will have other shares that you will need to give out. You may want to give out to advisors. You may think, you don't know everything today. So create a kind of an enabling ecosystem in your thing. Right? Fifth, whatever that point is, diligence will ask you for all the history from the date of the incorporation. Right? So create those Google links or drives or whatever filing repository you have, that everything gets covered. Get your DPIIT certification, get all that going. Think about all the stuff you need on your tech side, your Google access, your cloud access, figure all that out, right? And plan for all. Because if you come to me and says, I can do this item, मैंने किया नहीं है, क्योंकि वो Amazon पे करना पड़ेगा. भैया तुम्हें पे करना पड़ेगा. लैपटॉप पे जैसे पे करते हो खरीदने के लिए, वैसे वो भी करना पड़ेगा. So plan for that, right? Because if you don't do that, it's not going to work. It's as simple as that. So these little things will make a big difference. And finally, I think plan for money which is a little bit more. If you think that it's only your operations that you're going to need money, that's not true. You will have a whole lot of other costs that you will, maybe it's a fraction of the overall amount, but you'll still need it. So these are the small things. Yeah, go
Just a
ahead.
follow-up question. Around the contracts, especially between founders, have you found issues where money could not be raised just because
Two founders didn't get didn't get along, you will never raise money. Two founders don't get
No,
along,
I'm saying,
even if you see a rift.
I'm not saying from the perspective of that's a rift, but just because there was some contract that should have been put into place and was not done.
No.
Yeah, could be an agreement, could be anything.
No. So no, then that's not that my earlier response is invalid for that question. We've seen many companies where founders agreement has not been in place, right? What we assess from an investor perspective is, are the founders together? So we'll ask you questions like, how many years do you know each other? Where have you worked before? Why are you together? What is your vision? What is your vision, right? How are you going to raise money? How are you going to build the business? What are you going to do? What are you going to do, right? What happens if your wife is unwell and you can't get to work? You want to assess all these things. So I think we are not in a bureaucracy mode, but we are in a diligence mode.
Thank you.
Having said that, I just want to add that also the largest reason of companies not making it, at least in my portfolio, has also been co-founder conflicts. Wherein there
That's why my first response was that if there's a co-founder conflict, you won't play.
No, I think what I was trying to figure out was that two co-founders get along very well.
Yeah.
Is there a gap in documentation
No,
that
we
could lead to?
no.
No.
That we can get you to help you get that done. That's not a hurdle that
It's
can get
not
done.
an issue at all.
That's why I said we are not a
A
bureaucrat.
global contract is a contract under law.
Absolutely.
Okay, so if it is not documented, the investor will ensure that the documentation is completed. But if in completing the documentation, different viewpoints come out to say, I think it is this and I think, then that is the conflict kind of a thing that Padmaja is talking about. But not having documentation is not a big issue. Preferably, please do documentation.
Yeah. Go ahead, man.
I had a question adding to it because we faced this situation where the founder and the team has a good connect. That's okay. I wouldn't. But because of certain documentation in terms from investors, there is a disagreement. And then what happens is it's a like I don't want to this, but this happened with us where the investor said कि फिर मैं इनसे बात कर लूँगा. And when the investor does this, what does the founder do then?
So I think again I'll go back to a very fundamental thing. You are building a startup. You have launched your startup. You are doing a startup and a business between two people because you want to do it. It's your company. It's your business, and it's for you to do what you want to do. Just as you have other team members joining, you may have Amazon ka cloud coming in. You may have internet connectivity, right? Investors are bringing in the money. Okay, if you guys are not aligned and you can't take that and you break down under the stress, which an investor will do. Let me tell you, investors diligence like this. Okay, they ask hard questions and they ask questions which are very provocative. You need to that is to test how well you are knitted together. So if you feel that if the investor is saying that आप रहने दो मुझसे बात करेंगे, he says हाँ जरूर उससे बात करिए, but हम लोग दोनों बात करेंगे आपसे. That gives the message that you have a right to talk to anybody, but we are together. Or if they talk separately, then you should be both saying the same thing, maybe in different words, but the same thing. That's what he's trying to assess. That's why he's doing this. Okay?
I have a question.
Can I give? Okay.
Sorry,
Anyone?
He's been waiting for a while.
Yeah, go ahead. I'll come back.
Ma'am, I'm building a D2C brand and it's in the tech space. So when I come down to the point in your presentation where you said LOIs and purchase or take your sales confirmations, etc. So if you're, let's say, projecting a sale of 1 lakh units, probably with a turnover of 10 CR, how much of that should you actually accumulate before going out and saying ki, I need money to like actually take this product out, and these are sales orders already have?
So as I said, if you recollect somewhere earlier, is we are quite open to invest in pre-revenue companies. Okay, what we are looking for, that if we invest, is there somebody as a customer who's willing to pay for your product which you are building, right? So if you have in revenues of 10 crores, I don't see a problem. If you have revenues of 5 crores, I don't see a problem. So but what you need to decide is, if you're able to run the business as I said and create a revenues of 20 crores, for example, then please don't raise money. Because the earlier you raise money, you're going to be at a lower valuation and you're going to dilute more. So raise at a point where you're not running out of cash, you're not running without, you're not sort of up the creek without a paddle. But you are at a point where you're not also diluting purely because you've not spent the time to build the business. So you have to figure out, and typically I think it takes about 6 months. Keep that in mind. So you have to make sure that at an angel level, at a fund level, it may take slightly different. But you have to keep that in mind, that you want to dilute minimum and not maximum.
So we are at a POC stage right now, and
I thought you said 10 crores.
I'm saying with the POC, I'm going out to people and trying to take the purchase orders.
Huh.
So if I'm projecting that I'm selling, let's say, a unit for 1,000 rupees and I'm wanting to sell 1 lakh units, so the projection I'm giving is of 10 CR. So,
No, hold on. You are now confusing between what is on the table and what is projected.
POC दिखा के मैं
So
purchase order
POC में आपको एक LOI आ जाता है, आपको email भी आ जाता है from a relevant good customer कि if you do if this product goes out and you're ready to sell, I'm willing to buy at this price. That's enough to go and start talking to a investor. Okay. Whether you will achieve 1 lakh units of products sold, whether you will achieve 10 crore, that is a matter of diligence.
Thank you.
Because that's a projection.
I'm Rishika. So when talking about founders, you mentioned that the CEO should be a salesperson. Is it a disadvantage if the founders are techies and not salespeople per se?
No. All I'm saying is that if you are just techies and you can't convert your technology into money, which is revenue, then there is a problem. And typically, why we say the CEO has to be the person who's out there leading the company, who's going out to customers, who's able to bring in the team, who's able to handle things, right? A quiet guy typically can't.
So I wanted to ask about the co-founders itself. Like, the co-founders have evolved within the journey and they are not yet a part of the cap table, and they have been promised ESOP, and because promised not documented and all of that. So how is that situation looked at?
So to my mind, if the co-founders have no equity today and they're going to be part of the ESOP, then they're not co-founders.
That is strategic inflation.
It is basically, they are key management who will get ESOPs, which means 3 years, 4 years down the line, they will perform to do ABCD, and they perform well. You will be nice to them and give them a piece of the ESOP, which is not going to be, the whole ESOP pool will be what? Under 10%. Right. Broadly. Maybe a little more, maybe a little less, but that's it, right? If they don't have a sizable stake in the company today, they're not co-founders.
So what is the reason that they still stick together and the responsibilities and the growth that
they're not co-founders first of all. That's the first thing.
The name they're not.
They're not co-founders. They are key management. Right? Tomorrow they get a better job, they get a better opportunity, they'll walk. We as investors don't want to invest in companies where co-founders walk. we need to walk out after we make money, not the co-founders.
Thank you.
Yeah.
I was just again a follow-up question. At this stage, who are we supposed to talk to? Are we supposed to talk again pre-revenue, right? An incubator, an angel network, micro VC that looks at early stage companies. Who do we focus on?
Accelerator.
If you are a pre-revenue company and you think you have a plan and a projection that it is going to go into revenues very soon, you should talk to angel groups.
Angel groups, no incubator. No.
Incubator money is very useful when you are still figuring out your POC, when you are still being a technology. They'll give you 15 lakhs, 25 lakhs. I'm on the board of couple of the India's incubator thing. 15-25 lakh mein aapka hone wala kuch nahi. So if you've got a product, you're ready to, there is some endorsement from your customer base, then go straight raise money.
And just another question, we were talking about co-founders and all. What about startups where there are like single founders? And is that looked at, because a lot of people have told me they look at it at a bad light. I don't believe that, but
No, I don't think there's anything called good light or bad light. There is, we are not very excited about single founders, and I'll tell you the reason why. See, investing in a startup, as I said earlier, is a very risky game. Okay, and God forbid, right, a bus runs over the single founder, the business is done for. So that's the first risk mitigation we need to look at, number one. Number two, again something I referred to earlier, that God has not made any of us capable of everything, right? So I may be a techie and you may be a sales guy, we both need to work together, because I can't sell and you probably can't develop as good as I can, right? So that's why that complementariness is what will help build the company. Right? Third is, doing a startup is a most difficult career path that I can think of. Right? And if it's such a difficult career path, then, and I think in early stages of any company, the downs are much more than the highs. You have many valleys and peaks. Right? Just being energized and not demotivated. It's your co-founder who's going to lift you up. So I don't think it's a question of bad light, it's just good practical logic.
Just to follow up on that, how are couples seen as co-founders? Is that one thing, or seen as a bad thing?
Similar. If there's a divorce, what happens? For reasons beyond business, right?
Father, son.
Son gets married.
Son gets married. Dad gets divorced.
ma'am, just one more question. How do you also decide when you want to raise?
How do you?
Decide when you should be raising? Let's say
When you should be raising?
Yeah. As I
When
said,
you need the money, when you think you need the money.
assume
When you
have
think I
money.
won't have enough revenues, I don't want to invest, I don't have the monies to invest my own money, my own funds. I can see my business going ahead on reality terms, not in perceptive terms. Then raise money.
Okay, on that.
And you're not getting any of the other monies that I talked about, debt or grants or whatever.
What would be the true test of PMF?
Sorry?
True test of PMF. So we all believe that, okay, revenues are coming, customers are paying. PMF
What is PMF?
established. Product market fit.
Product
So we say it's established, right? We are getting money regularly, right? But even then, maybe it's a case where you are getting early revenues because product is novel or something, and later, investors or whoever the ecosystem finds out that no, it's not a case of product market fit. It was the initial enthusiasm of the entrepreneur which brought in revenue, and beyond that, it doesn't scale the way it should. So, anyway, are there any standard tests then one could put?
Yeah.
Yeah.
If your revenues are dipping,
Right, so NPS is low, retention is low. So that's the test.
at least from what I can understand. I mean, typically investors will have their own research and diligence, but from an entrepreneur's perspective, the first alert should be declining revenues, complaints, customer complaints, returns, all of those.
Thank you, Padmaja, for your session.
Thank you,
I have
Vikram.
another
Yeah,
meeting, so
sure.
I would have loved
Thank
to
you.
stay over, but
No, I'm glad. Okay.
I have one question. So, basically, if you tried, I can take it offline later also.
No, go ahead.
So, they say that the journey of a company, from 1 to 3, from time to time it varies, right? And you think you can do it all, and then you get people while you go. But how do you decide after a point in time? Ours is a 6-year-old company now. We're doing our revenue. We've also gone through few diligences last year where we learned all the mistakes that we do. But what is it like? How do we figure out that, like, where to seek the guidance from? That what to go for next? So before deep diving into just any investment that comes your way, or calling investment as the one of the only ways that you what to do with that money, also you have a certain picture. But when you need certain mentors or someone who's already done that path, how do you find that kind of guidance?
Very simple. You're sitting on a platform which is doing exactly this, which is TIE.
Yeah.
TIE's whole focus and objective is to inspire, mentor, and network entrepreneurs.
Well, now we've started that.
So I think number one is that TIE is a great place, and they have a system of figuring out who to match who with.
Yeah.
So that's a great way.
Yeah.
And at least my knowledge of TIE today is that most of their mentors, charter members, are first generation successful entrepreneurs who've been through that journey. That's number one. Number two, in life, we all stumble in life, in normal life, right? So who do we go to? We go to mentors, we go to parents, we go to people who can advise us. So as you start your journey of even thinking about a startup, build that mentor advisor network, right? Who you can bounce off things, who can just nudge you in a different, give you another perspective, right? So you get that. Third is talk to peer entrepreneurs. Right? What to do? This is an issue. How do I handle it? What did you do? Talk to peer entrepreneurs. And finally, if you have an investor, that's what I was saying, that high quality money is very important, not just money, right? Because money is today fortunately available.
Yeah.
But high quality money is what you need, because that is money which comes with mind space, it comes with mentoring, it comes with networks, it comes with telling you some things. They may sound brutal, but they are candid.
Yeah.
So I think those are things that.
Thank you.
I think we'll just wrap up the Q&A now and hand it over to Abhishek and
Yes.
for the portfolio.
Yeah.
Before we leave,